In the last month, a quiet financial kill shot was fired from Ottawa, and almost no one noticed the bleeding. It's a dry, technical policy change from the banking regulator, OSFI, and it has one simple, brutal goal: to dismantle the only real way everyday Canadians build generational wealth through real estate. You've heard of the dream: buy one property, use its equity to leverage the next, and climb your way to financial freedom. This wasn't just a fantasy, it was the tried and true blueprint that allowed regular working people, the nurses, the teachers, the electricians, to escape the crushing cycle of paycheck-to-paycheck living and secure a future for their kids. Starting November 1st, that playbook is dead. They just changed the secret math behind the scenes, and this single move will instantly shatter your borrowing power, fundamentally altering the calculus for every small investor in the country. This isn't just an amendment, it is an invisible, yet impenetrable, wall being erected right now, separating the financial elite from people like you who are trying to build real, lasting independence. Think about the sacrifice, the years of saving every extra dollar, eating rice and beans, and scraping together that first down payment. All of it was predicated on the promise that you could eventually leverage that first door into two, and two into three. This new OSFI rule, B-20, targets that specific mechanism with surgical precision. It's an untold story of how the system is quietly changing the rules of the game to ensure you never get ahead, guaranteeing that the housing market remains a playground for deep-pocketed institutional buyers. This feels personal because it is. They are taking away your ladder to stability, forcing you to compete with giants using kindergarten tools. The worst part is that they wrapped this dagger in such boring, regulatory language that most people will only discover they've been locked out when their next mortgage application is suddenly denied, leaving them confused and stranded. This is the truth they hoped would pass quietly. If you own a rental, or if you even dream of buying one, this is the most critical 5 minutes you will spend all year. You need to know how to navigate this crisis, or your financial future will be decided by bureaucrats in a room you'll never be invited into. Look, this channel is about uncovering the financial secrets they don't want you to know, the quiet moves that actually change the game. We decode the hidden policies and give you the playbook before it's too late. If you value knowing the truth and getting the advantage, hit that subscribe button right now. Don't let the algorithms hide the real financial news, the stuff that affects your mortgage, your wealth, and your family's future, from you. We've got the full story on how they killed the dream, and trust me, it gets darker. The entire foundation of the small-time investor strategy, the one your parents or mentors used, the one that built the modern middle class, was built on a simple premise: leverage. It was the genius of using your own income to secure your primary residence, and then utilizing the positive cash flow and equity of that asset to qualify for the next one. This buy, leverage, repeat model allowed a single-family home to become the first domino in a rapidly growing portfolio. But a few weeks ago, OSFI dropped a bombshell, issuing a statement so vague and technical that its real-world impact was initially lost in the noise. They were talking about the debt service coverage ratio, DSCR, and how lenders assess it, but the true meaning was chilling. They have introduced a new label, a hidden marker called Material Income Dependent Loans, MIDL. This sounds complicated, designed to confuse, but the implication is terrifyingly simple. If 50% or more of the income used to qualify for your mortgage comes from rent, that loan is now tagged as higher risk. This designation isn't about you, the borrower, being fundamentally riskier, it is about what it forces the bank to do behind closed doors. It forces them to slam the brakes on your growth, and it completely poisons the well for the strategy that has worked for decades. Consider the ambitious young couple who leveraged their small duplex into a fourplex. Their entire financial trajectory was dependent on the previous property's income being fully recognized. With the MIDL label, that income is now instantly devalued, categorized as volatile, and stripped of its former power in the qualification process. This one definition, this single, bureaucratic stroke of the pen, is the secret line in the sand, separating those who get to build wealth from those who are now deemed too risky to even play the game. They haven't made it illegal to own rentals, they've made it functionally impossible to use the most common, accessible, and essential tool, leverage, to scale that ownership. This policy doesn't affect the people buying their first home. it specifically targets those who have already achieved that baseline and are trying to move up to the next financial level. It's an attack on scaling wealth. Your ability to reuse equity and rental income has been severely curtailed, meaning that the dream of retiring early or building a multi-property portfolio is now a distant, nearly impossible hurdle for the average salary earner. This is no longer a matter of maximizing your portfolio, it's a fight for financial survival. The next hurdle is even worse, seeing exactly how much money they just stripped from your wallet. And the math is about to look like a nightmare. Let's look at the numbers because this is where the betrayal feels personal and the immediate financial damage is laid bare. Imagine you're a mid-career professional earning a solid $120,000 annually. Under the old rules, your primary residence mortgage, taxes, and bills take up a standard 40% of that gross income, leaving you with $72,000 in unused qualifying capacity. You then find a fantastic rental property, a small townhouse that you can rent for $3,000 a month. You were assessed on your full $120,000, and the bank would conservatively recognize 80% of the gross rental income, say, $28,800 a year, to show a strong, overall financial picture. That old, simple calculation gave you enough borrowing power to easily secure a new $500,000 mortgage from an A lender, a great rate, easy terms, and a clear path to expansion. Under the new rules, all of that disappears. The regulator is now saying you can only qualify using what is left, the remaining 60% of your earned income, or $72,000. But the devastating part is how the rental income is now scrutinized through the MIDL lens, severely limiting its effectiveness in supporting the loan. This drastically shrinks the pool of money you can leverage against the new property. Your borrowing power, the engine of your wealth creation, is instantly crippled, not by an interest rate hike, but by a subtle, cold change in an underwriting manual. This isn't a small reduction, it's the difference between easily getting a rock-solid approval from an institutional A lender and being kicked down to the alternative B lender market. The moment your file is flagged as material income dependent, the A lenders get nervous. They either decline you outright or, at best, impose draconian conditions. You are left with the B lenders, where the rates are punishingly high, often several points higher than prime, the fees are outrageous, and the terms are restrictive. For most small investors, the increased cost of capital, combined with the decreased leverage, means the deal instantly becomes cash flow negative or just no longer makes sense. This is a deliberate process of financial exhaustion. It's the system ensuring that only those who can pay large down payments or who have massive primary earned incomes, the already wealthy, can continue to play. The average Canadian family relying on rental income to supplement a single or dual working-class salary is now faced with an insurmountable financial hurdle. They didn't forbid you from investing, they simply moved the finish line so far back that you can't see it. But wait, the real reason they did this, the hidden motive, is even more cold-blooded and centers on the balance sheets of the big banks. Why would a regulator introduce such a dry, technical term, material income-dependent loans, just to hurt people trying to get ahead? The answer is not about your safety, it's hidden deep within the impenetrable fortress of the bank's balance sheets. This policy change is rooted in an old banking rule, capital requirements. When a loan is labeled higher risk because it relies too much on rental income, the bank is now required to hold significantly more cash reserves against it, a larger, less profitable emergency safety buffer against potential losses. Think of this capital reserve requirement as a secret, invisible tax on your mortgage. When a bank has to hold on to more cash, that cash is sitting idle, it's not being lent out to make them money. Banks are relentless profit engines. To protect their massive margins from this new regulatory tax, they must do one of two things: dramatically raise interest rates on those loans, thereby passing the cost of the reserves onto you, or, for more commonly, tighten the rules and simply decide those smaller, risky MIDL loans aren't worth the hassle anymore. They will prioritize lending to less complicated, high-margin, low-risk clients. This technical change in Ottawa translates directly into tougher approvals, higher borrowing costs, and fewer options for you and me. The big pension funds, the REITs, and the private equity firms, the ones buying up thousands of units across Canada, don't use the same type of residential, personal income-based lending. They operate in the world of large-scale commercial financing, which is largely insulated from these B-20 rules. They feel nothing. This policy is a perfectly targeted weapon. It is designed to make small investors unprofitable and administratively complex to lend to, thereby freezing them out of the market. The bank looks at a small-scale investor and sees a complex file requiring extra capital to be held, which means less profit. They look at a corporate entity and see a clean, large-volume transaction with more favorable capital treatment. The decision for the bank is easy, and you are the casualty. This is not regulation for the sake of stability, it is regulation that acts as a structural subsidy for the wealthy. It's a gift to the giants, wrapped in dull, deliberately confusing regulatory language. And that leads us to the heart of the matter, the policy's true target. Let's be brutally honest about who this policy actually hurts. This isn't felt by the mega investors, the institutional giants with teams of finance experts and billions under management. They are completely unfazed. They have access to complex, massive-scale commercial lending and deep capital pockets that allow them to bypass these consumer-level lending rules entirely. They are barely going to acknowledge this change. This is a dagger aimed squarely at the heart of the everyday Canadian dream, the mom-and-pop investor, the ambitious young professional trying to buy their first duplex, the family trying to use a rental property as a stable, secure retirement plan instead of relying on a volatile stock market or an inadequate government pension. This policy adds a layer of brutal friction that fundamentally limits how everyday Canadians can use leverage, the single greatest, most accessible tool for building wealth that isn't dependent solely on a high-paying job. The goal isn't just to increase bank safety, the effect is to quietly change who gets to play the real estate game in Canada. When small, family-run investors are choked out of the market, when their ability to scale from one door to two is killed, who instantly steps in to fill that vacuum? The institutional buyers, who can pay cash or access the commercial debt that remains untouched by this rule. It is a systemic, orchestrated consolidation of housing ownership. By making it financially unviable for individuals to secure the necessary financing, the system guarantees that corporations dominate the acquisition of rental stock. This drives up competition, reduces housing quality, as rights prioritize profit over tenant experience, and ultimately keeps the average person dependent on either an employer or the state for their financial survival. You are being forced to compete in a market where your biggest advantage, the ability to use debt efficiently, has been surgically removed. This is not fair play, it is balance sheet warfare against the middle class. The working couple who wanted a fourplex to fund their kids' education is now sidelined, while a multi-billion-dollar pension fund acquires those units effortlessly. It's a transfer of wealth, disguised as a prudent regulatory measure. But wallowing in the injustice achieves nothing. It's time to stop mourning the old rules and grab the hidden key to the new ones. But here's the crucial shift. We can't be passive victims of this policy, we have to adapt, move faster, and build a playbook that renders their rules irrelevant. The biggest takeaway isn't about the rules themselves, it's about your true objective. Was the goal to just own a ton of doors and deal with tenant calls every night, or was it financial freedom, security, and true independence for your family? The good news is you can still achieve that, but you must do it differently, with a ruthlessly efficient, new strategy. This is the new playbook, your 3 immediate, actionable steps to turn this threat into an opportunity. 1. Refinance now, while you can, the final window. If you currently own a rental property that is highly leveraged, you have a small, quickly closing window, until November 1st, to refinance under the old, favorable rules. This is not a drill. By locking in your equity position and your favorable debt structure now, you secure your current portfolio from the MIDL landmine and create a cash flow position that is more flexible under the new regime. Do not wait for your existing mortgage renewal, consult a mortgage professional immediately to understand your options. Secure the financing under the old terms, or risk having your future borrowing power instantly crippled when the clock strikes midnight on the deadline. This is a defensive, urgent move. 2. Build the ironclad file, the new standard. Moving forward, any rental purchase requires a radical upgrade to your financial presentation. You must now focus on deals that show significantly stronger cash flow on paper, far beyond what was previously required. You need to present a bigger down payment, 25% or more should be your new minimum target, to reduce the loan-to-value ratio and make the bank feel safer. Most importantly, you must partner with a specialized mortgage broker who understands exactly how to structure your deal to minimize the risk of the material income dependent tag. You are now selling the bank on safety and profitability, not just compliance. This shift demands patience and higher capital reserves, but it keeps you in the game. 3. Diversify and decouple, the ultimate freedom strategy. If Ottawa is making real estate leverage this tough, use that capital and energy elsewhere to build wealth that is outside the regulator's reach. Your goal is not property, it is freedom. Focus ruthlessly on becoming mortgage-free faster on your own home, building a stable, unassailable foundation. Then, buy modest and invest the rest. Diversifying into asset classes that are liquid, non-debt dependent, and not subject to OSFI's changing whims, like high-quality, dividend-paying ETFs, strategic allocations to physical gold, or calculated positions in stable crypto markets, is no longer an option, it's a requirement to maintain a growth trajectory. You must decouple your financial future from the residential real estate market's increasingly restricted rules. The wave of wealth building is still moving, you just need to shift your surfboard to catch it elsewhere. This isn't the end of real estate investing for Canadians, but it is the definitive, unchallengeable end of the simple, outdated playbook that past generations relied upon. The system, through the quiet violence of a technical policy change, has decisively raised the stakes. It has made it clear that a middle-class income is no longer enough to build a substantial, leveraged rental portfolio using the old rules. The quiet betrayal has been executed, the lines have been drawn, and the game has fundamentally changed in favor of the biggest players. Your choice now is simple: lament the injustice and get left behind in the dust of rising institutional power, or master the new rules, adapt your strategy with fierce discipline, and keep pushing for your financial freedom. The ones who understand this shift today, the ones who use this threat as the catalyst for immediate action and diversification, are the only ones who will still build wealth in this country tomorrow, smarter, safer, and most importantly, on their own terms.